Welcome to our comprehensive journey through financial statements, from A to Z, uncovering their vital importance. These statements are crucial tools, helping us deeply understand a company's financial health and overall performance. Today, we'll focus on the three key financial statements, which are fundamental for any business analysis. These statements serve as essential tools, providing deep financial insight into a company's operations and position. First, we have the balance sheet, a critical document that offers a snapshot of a company's finances. It precisely shows a company's financial position at one specific moment in time, like a photograph. The balance sheet clearly lists a company's assets, its liabilities, and the shareholders' equity. Next, we examine the income statement, which reveals a company's financial performance over a period. This statement reports all revenues, expenses, and the resulting profits or losses over a specific period. Ultimately, the income statement measures a company's overall profitability, showing how much money it truly earned. Finally, we have the cash flow statement, which tracks the movement of cash within a business. It specifically tracks all the cash flowing in and out of a business, providing a dynamic view. This statement is vital for assessing a company's liquidity and how effectively it manages its cash. Let's dive deeper into the balance sheet, understanding its components and what it communicates. The balance sheet snapshots a company's financial position, listing assets, liabilities, and equity. Assets equal liabilities plus shareholders' equity. Now, let's explore the income statement, which reveals a company's profitability over a specific period. The income statement shows revenues, expenses, and net profit over time. It measures profitability. Net profit is total revenue minus total expenses. Next, we'll focus on analyzing cash flow, a crucial aspect of understanding a company's financial health. This involves understanding the precise movement of money, both into and out of the business, very carefully. First, let's understand net cash flow, which is fundamental to assessing a company's cash position. Calculate total cash inflows minus total cash outflows to see if a company generates surplus cash or faces financial strain. Then, we look at free cash flow, or FCF, indicating cash available after essential expenditures. FCF determines cash available after operating costs and capital expenditures, usable for growth or debt repayment. Finally, we utilize key cash flow ratios to gain deeper insights into a company's financial state. Ratios like operating cash flow ratio and cash burn rate assess liquidity and long-term sustainability efficiently. Now, let's explore key liquidity strategies, essential for ensuring your business remains financially stable. These strategies are critical for ensuring your business stays afloat and can meet its short-term obligations. Maintaining an optimal cash reserve is vital for handling unexpected expenses and financial fluctuations. Aim to keep 3 to 6 months of operating expenses in cash, managing any unexpected costs effectively. Improving accounts receivable is crucial to accelerate cash inflow from your customers swiftly. Shorten payment cycles and offer early payment discounts, speeding up cash inflow from your valuable customers. Effectively controlling accounts payable helps manage your outflows and optimize working capital efficiently. Negotiate better payment terms with suppliers, avoiding early payments unless a clear discount benefit exists. Optimizing inventory levels is key to preventing cash from being tied up unnecessarily in stock. Avoid excessive stockpiling, which ties up cash. Use just-in-time systems to reduce holding costs effectively. Securing short-term financing options provides flexibility for managing seasonal or unexpected cash needs. Maintain access to credit lines and overdraft facilities for handling seasonal or unexpected cash flow needs. Today, we'll explore how financial ratios help us make smart, data-driven decisions in the business world. These powerful tools unlock deeper insights from raw financial data, revealing a company's true health and potential. First, let's examine short-term stability, which is crucial for a company's day-to-day operations and survival. We use liquidity analysis to assess a company's ability to meet its immediate, short-term financial obligations quickly. A key metric here is the current ratio, calculated by dividing current assets by current liabilities. It's very important. Generally, a current ratio higher than 1.5 indicates strong liquidity, meaning the company is financially sound. Next, we'll shift our focus to long-term performance, looking at a company's sustained financial health and growth. Profitability analysis helps us measure how efficiently a company is earning profits from its operations and investments. The net profit margin is a crucial profitability ratio, calculated as net profit divided by revenue, then multiplied by 100. We also conduct debt analysis to thoroughly evaluate a company's financial risk and its reliance on borrowed funds. The debt-to-equity ratio, found by dividing total debt by shareholders' equity, reveals the company's financial leverage. Analyzing financial statements isn't always straightforward. There are definitely some key challenges we need to be aware of. We must learn how to navigate the inherent complexities of financial reports to avoid misinterpretations and make sound judgments. One significant challenge is the potential for manipulation of reports, where companies might intentionally alter data. Companies sometimes alter data to appear more profitable or financially stable than they actually are, which is misleading. Another challenge comes from non-cash adjustments, which can obscure the true cash flow picture of a business. Income statements include items such as depreciation, which don't reflect actual cash flow, making analysis more complex. Even a profitable company can face severe liquidity issues, struggling to meet its short-term financial obligations. Indeed, a profitable company might still experience cash flow problems, making it difficult to pay its debts on time. Finally, complex structures of multi-entity businesses often lead to reporting that is incredibly difficult to decipher. Businesses with multiple entities often present complicated reporting, which can be quite challenging for accurate analysis. Let's categorize financial ratios into 4 key groups, each offering a unique perspective on a company's health. These categories provide different angles to thoroughly evaluate a company's financial performance and overall stability. First, we have liquidity ratios, which are essential for understanding a company's short-term financial health. These ratios specifically measure a company's ability to meet its immediate, short-term financial obligations effectively. Key examples include the current ratio and the quick ratio, both vital for assessing short-term solvency. Next, we delve into profitability ratios, which reveal how efficiently a company generates earnings from its operations. They measure a company's earnings relative to its revenue and the expenses it incurs, showing its efficiency. Important examples are the net profit margin and return on equity, or ROE, which show earning power. Third, we have efficiency ratios, which assess how well a company utilizes its assets and resources. These ratios measure a company's operational efficiency in effectively using its resources to generate sales. Examples include inventory turnover and asset turnover, which highlight how effectively assets are managed. Finally, solvency ratios are critical for understanding a company's long-term financial stability and debt-paying ability. They measure long-term financial stability and how effectively a company handles its debt obligations over time. Key examples are debt-to-equity and interest coverage ratios, indicating the company's long-term financial health. Let's explore the real-world applications of financial statements and why they are so vital for various stakeholders. Financial statements are vital for investors to evaluate growth, banks for loan approvals, owners to cut costs, and governments for compliance. To wrap things up, let's review the key takeaways and summarize the essential concepts we've covered today. These are the key takeaways that you should remember, solidifying your understanding of financial analysis. Remember, financial statements like the balance sheet, income statement, and cash flow provide a complete picture of a company's health. The balance sheet specifically shows a company's financial position and stability at one specific point in time. Meanwhile, the income statement reveals a company's profitability and overall performance over a specific accounting period. And the cash flow statement tracks the actual movement of cash, providing crucial insights into liquidity. Financial ratios, as we discussed, offer deeper insights into liquidity, profitability, efficiency, and long-term solvency. Effective cash flow and liquidity management are absolutely crucial for ensuring a business's continuous operation and survival. Ultimately, interpreting these statements is essential for all stakeholders to make truly informed and strategic decisions.